And my favorite thing that my econ professor said is, imagine if you're an alien looking down on Earth and you watch Nathaniel take his dog out and go to the bathroom. You would think that the dog is in control because he's taking his owner out. Nathaniel picks up after that dog, right? And that's coming from a very different line of thinking. And if you think about it like that, also it starts changing your mind. The point of it is that you have to think in lenses. You have to think out of it in multiple areas to be able to come up with the conclusion. And tax is only one lens. It is a portion of it. So please think about other things that are impacting your decision. And if you don't know, talk to a professional about it, push your CPA on it. Sometimes more taxation is just the right answer. And sometimes it's not. It just depends. Welcome to Critical Thinking Required, hosted by LBW. This podcast is intended for free thinkers, entrepreneurs, and knowledge seekers. Join us as we discuss relevant financial topics, explore with guests their financial journeys, and engage with experts in industries such as space, media and entertainment, real estate, and many more. Buckle up and enjoy the ride.
Yeah, it reminds me of Dirty Dancing. So it's shoot.
Wasn't it Dirty Dancing?
Yeah. So you start again.
Shoot up, do
Shoot up,
ba 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 boo.
Shoot up,
Ba 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 boo.
shoot up,
In the still of the night. Butchered it.
Yeah, you missed it. Nathaniel does have a beautiful voice. Dan, you could use some work. Welcome to Critical Thinking Required. Here with your hosts, myself, Tim Bickmore, and my two colleagues who are sitting together today, Dan Weiss and Nathaniel Leach. Thank you for everybody for listening to us. Today, we have a topic that I think a lot of people may be interested in as we discuss what we like to call a tax bias. And we'll get into what we mean about that, but we're going to talk about taxes. We're going to talk about tax strategy. We're going to talk about how to think about it and different aspects when it comes to planning, maybe investment management. Danny could throw in a couple words there, but that's what we will be speaking about today. And before we start, as always, if you like what we do, you like the three of us, you just want to give us a little bit of support, please like, share, and subscribe to our podcast channels. But today we want to talk a little bit about tax bias. So who wants to start off? Maybe Dan. Talk a little bit about what we mean when we say a tax bias, because I'll admit everybody on this podcast would say, yeah, I don't want to pay taxes. I don't have to. Of course. That just makes sense. But what do we mean by tax bias, Dan? Go ahead and get us started on that.
I'll do what I can. This is Tim's idea. It's a great idea to talk about this. It's going to be hard enough just trying to behave myself. Nathaniel and I sitting here together.
He's a smelly bastard.
Well, there you go. I guess we'll start with that. What Tim is referring to is a day-to-day experience we have with individuals that will get at times tunnel vision when they consider taxation, because the focus can become so strong about making a decision that is based off on how it impacts you today. Usually, sometimes it's tomorrow, but usually it's today from a tax standpoint, that it misses the forest for the trees, I think is the expression. So that's really what we're going to be kind of covering. This is an interesting topic for us, right? Because I think we've talked about this briefly before in other podcasts. It's interesting for us because when just going through like my experience going through business school, for example, a CPA mindset is technically, it is structured, right, from a formal standpoint to think from the past to the present. Whereas somebody like the three of us, who are often looking at forecasting, are taught to think in terms of present to the future. Now, both of these are extremely useful mindsets, but I know where we spoke about this before. We spoke about this in our podcast about an inconvenient convenience, because we often see where these professionals will try to manifest both, and that can be problematic, right? They both have their place. And so that's really what we're covering, is it's not, you got to consider both.
And I think a good way to start too, Dan, is talking a little bit about the incentive of a CPA. because what happens is we get conflicting advice coming to us. But I just want to like lay the groundwork of a CPA. So let's just put the CPA on the spotlight and say, you're in the business of doing tax returns. We hear about from CPAs all the time. What do clients say to them when they come to them? Why am I paying so much in taxes? Make me not pay so much in taxes. And so what they'll do is then they'll go ahead and make certain strategies or make things where they don't have to pay as much in taxes. But what is missed within that is, again, that forecasting, that moving forward. And I don't blame CPAs. I really don't, because I would get sick and tired of having to get hound about like, I paid too much in taxes. And then the answer being like, well, you made too much money. And I think that sometimes the idea of the customer or the client is that they can always whittle taxes down, which is sometimes very difficult. Sometimes it gets very gray on how you're maybe approaching those strategies. And if you're comfortable with that, are you not? But at the end of the day, nobody's told me I love my CPA because they make me pay more in taxes. So that overall that overall concept or I guess not even a bias, but like incentive is, of course, the CPA is going to try their best to just make sure you eliminate taxation, because that's how they kind of get valued. And so you have to understand that piece as well when we're talking about this tax bias, is it's just in which the system CPAs live in as well. I just wanted to throw that out there so it kind of sets a stage.
I'm glad you did, because actually we're not here bashing on CPAs. We'll come to the defense of a good CPA all the time. And a lot of times when we ask clients if they like their CPAs, that's how they're judging their CPAs is, am I getting a return in the past couple of years? And that's how they're qualifying, because they don't know how else to qualify a CPA if they have a good CPA or not. And that is not, that's not a complete picture, right? But people don't know to think differently about that.
Yeah, I would agree. So if we're taking another step forward, Dan, from the standpoint of like, all right, kind of laying this tax bias out, could you give us any examples of how we see some of this tax bias come in and where it truly affects some people?
Yeah, okay, it's gonna be fun. So here's one that we see all the time. We'll see situations where investment managers will not sell off assets because they do not want to trigger a realized gain in selling those assets off. And so we'll come across portfolios, typically that, a lot of times they're inherited portfolios, but portfolios that haven't seen activity for, in some cases, decades, because nobody wants to trigger the taxation. And yet there could have been a lot of reasons to do that, right? At some point you pay taxes. That's just the case. Unless you want to hold that portfolio, and in this case, I'm talking about a non-qualified portfolio, something that does not sense out of a retirement account, although we see it there too. But in those kind of situations, someone's going to pay taxes unless you want to hold on to that your entire life and then pass away, hoping to give that next person a stepped up cost basis. But then qualitatively, I'd argue, what was the point, right? You spent all these efforts, unless your point is driven, I want to build generational wealth, period. That's all I care about. I just don't see the gain in doing that, and because you're also missing other opportunities possibly along the way because you didn't sell. But that's a very common thing that we see that just doesn't make sense. Similar to the CPA comment too. I think a lot of times people might justify whether or not their advisor is a good advisor because they're not triggering taxes. But that's, again, very short-sighted. So there's my first example. He's ready.
So I'm going to piggyback off of Dan's. So some qualifications here. What Dan is speaking to is that we're not against holding for the long term. That's how we invest to begin with. Our argument is that we believe that there are a number of advisors out there who say they're, quote, managing, end quote, the portfolio, but they're really not. They're managing it, say, for tax efficiency, to Dan's point. But do they know and truly understand the individual companies that they are actually invested in? We would argue that is likely not the case. So if their primary reason is to leave something alone because they're afraid of triggering tax gains, to us, that's a big red flag, because to me, that means that the primary reason for buying or selling anything is you either understand it or right? Or you understand it to the point that you know whether it's a good decision to buy or sell it. And it's based on the fundamental reasons that you own it in the first or want to sell it in the first place, which is, does this thesis no longer make sense, or does it make sense to buy more of it? That should always be the primary reason for any such investment.
I think too, to go to your point, is that what you're saying is you have to be willing and able to assess the situation as time evolves.
Yes, you have to be willing to adapt as the circumstances change. Yes.
I think that's kind of what you said was very well. I miss the days where I got to interpret a lot of Nathaniel to the public, because he does a fine job doing that. But I think that's what it comes down to, is that you have to be able to make these changes. And by the way, too, those tax code changes too. So it's not like you can just kind of sit there too. And actually, I want to throw this back to Tim. We see this a lot too when it comes to different equity options, and a very just lost audience on what taxation means there and how it impacts.
So when you say equity options, you're talking about people's stock compensation?
Yeah.
If they work at a certain company.
So
right?
he interprets for me too.
Yeah. I think like you guys hit on it pretty well on the investment management side, but there's also issues on the planning side when it comes to looking at planning strategies, which planning does have to go into like tax loss harvesting and kind of what you two are mentioning. But in addition, you also have to make decisions when it comes to when you're going to incur taxes. I mean, equity compensation is a wonderful example of that. And we've talked a lot about it on different podcasts. So please go and watch those podcasts, because we do discuss it. But what's hard for people is that when you're trying to make one decision, I think Dan hit it on the head very well when he opened up the podcast, that people try to start making decisions in an isolated or in a tunneled way, like tunnel vision. So they'll come to us, say, I hear about these companies that can help me liquidate my stock, and I want to do that because I can exercise today. And if the company IPOs or goes public in some manner, it's going to be hyper growth and I can save all this money on taxes. And it's like, okay, great. I totally understand it. I get it. We could be talking about hundreds of thousands of dollars of savings, but have you done your due diligence on these companies that are going to allow you to exercise? And they're like, well, no. Okay, well, you need to go to these companies and ask them how much they can take. And they're like, well, I'm not really sure yet. I'm like, well, I've done that due diligence and they could take up to 100% of your gain. Like that is part of their contract. It's very subjective. You kind of have to go through the process. You have to read the red tape. And then all of a sudden it may not make sense. It may make sense just to pay the taxes instead of giving up your gains with the said company. But then in addition, what will happen is, because these companies are most likely privately held and haven't gone through the public public offering process, what will happen is that these options, specifically options, you have to bring cash to the table in order to purchase them, right? That's why they're going to these outside companies, because they may not have the liquidity to do so. In addition to that liquidity, if you have cash, what a lot of people will say is, but I'm also really concentrated. So now you have really two conflicting arguments, right? You have, I want to save on taxes, so I want to exercise today, but I also don't want to exercise today because I don't want to give up all my liquidity to purchase this illiquid asset and be highly concentrated in it. But I also don't want to pay my taxes. And all of a sudden what happens is you get this big roadblock, or these two don't work together. You kind of have to pick which route you want. What matters most, your concentration or your taxation? And where you start really looking at it is a concentration has a lot of risk to it. And again, Nathaniel will say that we're like to do heavy bets, right? If you find a home run, you want to put a lot of money behind it. Like, we understand concentration, but there is risk there. And what happens is that where people get caught up, it's like, if this really hits, like, yes, you could save on a couple $100,000 of taxes, but you also just made a ton of money. Like, it's not like you're not making money to incur these taxes. And so it's, where's the difference there? It's like, okay, let's say you have 20 million versus 15 million. Like, yeah, $5 million is a big difference, but like, you kind of just hit the lottery. Like, you should just be excited that you hit that 20 million, like you got $15 million. Like that's a pretty good bet. So you have to understand what you're really truly willing to risk versus what you really want to hit on taxes. And then that flows down into a lot of decision making where people get so heavy on just like, I do not want to pay taxes. Our country was literally birthed on that. And so it's a huge conversation that's like, I don't want to pay it. I don't want to pay it. But it forces people down a decision-making process that they're not looking holistically at the entire picture. And that's a problem. So I'm not sitting here saying, don't pay, you're going to pay taxes. I'm sitting here saying, it's bigger than just taxes. You can't just look at it from a tax lens. It's one lens and a very large number of lenses that we have to look at to see what route you're most comfortable with. And I think that's the frustration that comes out of this podcast, is that people want to focus on just that specifically. And it's just not, in my opinion, the most appropriate route. I think you need to look at it more holistically and understand all angles before you start making those type of decisions.
Yeah.
Sorry, I didn't quite understand his first point about giving up 100% of the gain. Could you clarify on that point?
So there are companies out there such as like SEC-FI. There's another one that I heard too, where companies have now come out, and what they will do is they will give you money up front, give you a loan essentially to purchase your options. And sometimes they'll also cover like your AMT taxes. But everybody's in business to make money. So how do they make money? Well, they participate in the gain with you. And we have called up those companies, and they do have the ability to take 100% of your gain. They have that ability. So you have to understand what you're getting yourself into. So it's fine print. Now on their website, they'll promote like, this person saved X on taxes and this is what they made, right? It was a lot better. But you, as Nathaniel will say very well, you have to read the fine print, because you need to understand exactly what you're getting yourself into, because it's always not that clear cut.
So then what's the incentive to the person who's taking advantage of these kinds of programs to then give up 100% of their gain? What's in it for them?
There's nothing. That's a problem. And that's when we actually called them up and asked them about it, right? You have to understand exactly how these programs work. That's my point. Is that these programs sound cool and they sound great. And I'm not saying that people shouldn't do it. What I'm advocating is that people should do their due diligence. People should read the fine print, understand what they're truly signing on to, because it may not be worth it. It may be worth it though. I would use the analogy to student loans. You go to SoFi, you go to whatever, and they're like, look, come refi our loans on our website. And you're like, oh my gosh, it's 3%, it's 2.5. And it's like, yeah, that's for like the 1% of people that go on their platform. Did you know that? Like, go put your numbers in and see actually what rate they're going to give you, because it's actually not as good as what you have right now. Oh, really? Yeah. So that's where like SEC-FI promotes that. Yes, great. This is great. True. But that doesn't mean it's going to be the case for every single person, because they're going to underwrite that differently. So that's why you just have to do your due diligence. So not bashing it, just more of like, make sure you understand what's going on.
Yeah. So there's a way to think about this. And then of course, specifically apply it. I think Tim used the word lenses. I think that's a great way to put it. Here's a couple lenses. And I'm going to throw a lens over to Nathaniel here in a second, on a hot topic that's going to probably heat him up, mainly for everyone to see and for my own enjoyment. One, I mean, sticking with the stock option piece of things too, it's amazing how many times people will get stuck on their love for, restricted stock units as opposed to other particular options. And it's not necessarily good or bad. It just depends on the scenario, right? You can control your taxation better, perhaps using an ISO than an RSU that's going to get taxed when it vests. And just to understand that is important. Where we see it a lot of times too is we'll see it, for example, in real estate, where somebody will say, oh, I will 1031 exchange one property into the other to avoid taxes. Don't get me wrong. That can make sense. And that could be a very useful situation. But many times over, we've seen people do that and all they're thinking about is taxation. So what happens is they have to buy a like property of equal or greater value when they do that 1031 exchange. And sometimes they're held with a bag of shit, because they weren't so concerned about what they were basically trading up to. They were just concerned about avoiding taxes. Great, you didn't pay the taxes, but now your underlying asset may not be quality. So you're going to suffer some other situations that are probably greater than the taxation piece. And
in the 1031, they do put you on a shot clock. Like you better have that next property ready to go. I believe you have up to 180 days.
So 6 months. Okay.
I believe. Yeah. And you have to declare, I think, within 90, I believe. There's 2 time limits. I'd have to double check to be very clear on that, but I believe it's 90
short window nonetheless.
Yeah, which doesn't necessarily lead to great decisions when they're trying to push that too, because you've got to find something.
And that's just being prepared to use it, knowing like, okay, I know I want to sell this. Okay, let me time it up. But then it's also timing of, can you get that deal done? Can you not? and you have to have the intent, but there's just, again, there's more to it than just like, I'm going to roll my gains over. It's that easy. Like, no, the government doesn't make it that easy.
We also have a lot of conversations about the whole argument between traditional IRAs or Roth IRAs, 401ks, you can use interchangeable, but those type of accounts, what we see from a lot of our clientele is that it is debatable, but probably unlikely that they're actually going to see themselves in a lower tax bracket later on in life, because they're maximizing their qualified accounts, which they will, if it's a traditional account, have to take money off of those later in years, which is going to be treated as income. And because they're maximizing those qualified accounts, they're having to sock money into non-qualified assets that don't have the same kind of tax shelters. And so what we're seeing is a lot of our clientele, although they might be in a high bracket or the highest bracket now, are perhaps so focused on, well, I need to figure out how to do a deduction now because this is where I'm in a high bracket. They tend to forget perhaps that they're always going to be in a high bracket because of their specific situations, and they need to consider that. So we get a lot of conversations about, well, you can't forget about the compounding factor of a Roth, assuming that things don't change, which is a whole nother conversation we don't need to get into today. But assuming they don't change, let's say we're wrong about the bracket being what it is 30 years down the road. You can't forget about 30 years of compounding growth that you're not paying taxes on. So it's, again, just to go to the point that I think Tim is making about the mindset of how you have to think about these things, and Nathaniel's point about, hey, things are going to change and you have to assess at that time frame. It's just not a black and white situation. So here we go. I'm going to set Nathaniel off now, again, for your own edification and my enjoyment. So Nathaniel, how do you feel about people's general viewpoint on tax loss harvesting?
He knows just what buttons to push. But I'm not going to react as he wants me to react. I will be very measured. So tax loss harvesting has very akin to what we talked about today with CPAs. How are they valued? Well, one could argue that financial advisors like us who invest other people's money are valued by utilizing the technique tax loss harvesting, which typically means at the end of the year, an advisor will go through the unrealized gains and losses within their clients' portfolios. And what will typically be attempted is that they will look at those with unrealized losses and those with unrealized gains within a portfolio, and they will then sell them off such that the net tax impact will be minimal to none to negative in some cases to the client. And where we take issue with this is that the advisors they may be very well determining, okay, well, this one with a huge loss, it hasn't done very well. I don't understand it that well. We should just get out of it. And then there's this one that's done very well, and we want to harvest those gains, and therefore we're going to sell it. And then the combination of the two will be zero tax impact. The problem with that is just the whole concept in general, in that those companies might just be having the company that has a huge unrealized loss may either just be having one bad year, and the next 10 years are going to be incredible. That's just the way their industry works, for example. Or maybe the thesis is fundamentally changed, and as a result, the company is going to do well over time. As the company does well, the stock price will follow, especially given a long-term investment time frame. And then second, the thesis might have fundamentally changed such to the point that even though you're seeing, say, a 50% loss on your investment, it might actually make sense to purchase more of that company. So with tax loss harvesting, there's something called the wash rule, which means that you can't repurchase that company that you may have just sold, that is of the actual company or a company that is very similar to it. Same thing for mutual funds, by the way, except after 31 days. So the other problem I have is that there is a huge risk that that company's price could do one of these, could go right back up due to market sentiment. You never know. You will always take a risk in such things. It only makes sense to do tax loss harvesting. I'm doing quotes for those of you who are listening. When you have lost your confidence in your analysis of the company and the thesis, and you believe the thesis, or you believe the thesis has changed, and you've decided to sell off that entity, and then that's it. That's the only reason in my mind to utilize tax loss harvesting
From a portfolio management standpoint.
Correct.
Makes
Oh, you were
sense.
very composed on that.
He wanted to get a rise out of me. I've learned.
The day is young.
The day is young, yes. I want to make a clarification. So while Nathaniel was talking about his tax loss harvesting, for 1031 exchanges, there are 2 time limits. The first one is 45 days from the date you sell the relinquished property to identify potential replacement properties.
Holy.
That's nothing.
And the second limit is that the replacement property must be received and the exchange completed no later than 180 days after the sale of the exchange property or the due date as well, with extensions of the income tax return for the tax year in which the relinquished property was sold, whichever is earlier.
Oh,
So you got to move.
wow.
Gotta move.
Yeah, that's hard to set that up within a 6-month time frame, and then 45 days. Whoa.
Yeah, you got to deploy capital quick. No, it's important. And especially in today's real estate market, just want to say that. So, woo, it's fast. So overall, my final thoughts are, I went to a liberal arts school. I went to Lawrence University, and at liberal arts school, what do they teach you? They say, we're going to teach you how to think, right? You're going to learn how to learn. I loved it and hated it all at the same time when they told me that. And I think that my overall point, though, is what they really taught. It was my first econ class, and I loved it. And they talked about lenses. What lens are you identifying this problem with, right? And I think that's just such an important fundamental thing to think about with any problem solving that you're trying to do. And my favorite thing that my econ professor said is, imagine if you're an alien looking down on Earth and you watch Nathaniel take his dog out and go to the bathroom. You would think that dog was the king.
The dog goes to the bathroom, not me.
Yes. Yes, the dog goes to the bathroom. You would think that the dog is in control because he's taking his owner out. Nathaniel picks up after that dog, right? And that's coming from a very different line of thinking. And if you think about it like that, also it starts changing your mind. The point of it is that you have to think in lenses. You have to think out of it in multiple areas to be able to come up with the conclusion. And tax is only one lens. It is one lens to look at a financial problem through. It is not every lens. It is not the whole lens. It is a portion of it. So please think about other things that are impacting your decision. And if you don't know, talk to a professional about it. Push your CPA on it. Sometimes more taxation is just the right answer. And sometimes it's not. It just depends. Just depends. You have to look at it from multiple angles. That is my last and final thought.
I just would echo Tim's thoughts in that don't do your due diligence. Do your due diligence. Never make any assumptions and don't make irrational decisions when it comes to stuff like this, because it may sound like a good deal in the short term, but sometimes in the long term, it can come back and bite you in the ass. Dan?
So we had a great guest, Brian Levinson, is a friend, come and talk about like being present where you stand, which is really important. I'm going to expand upon that a little bit further. So it is important to be present where you stand, and mentally, it's very important to know where you stand. And so that way you can start figuring out where you want to be. And that's how I think you can really kind of absorb a lot of these different changing elements. It's just don't get yourself in a solo kind of a siloed mind frame. It's important to turn every stone. We try to do that in our lives, in our practice all the time, to make sure that all angles that at least can be known are known. It's no different here in this case. Look, everybody has to pay their taxes. It's just what it is. I know people don't like to pay those taxes. No one loves to, but there's reasons for it, and you can't get away from it. At some point, you pay the piper. So just make sure it's not the only consideration when it comes to setting aside your financial life. It is important. It is a consideration. There are things that you can do or makes complete sense. We were in a conversation earlier this week. It's a conversation we have all the time about like personal exemptions on homes. If you own a home and you leave that house and buy another home and keep that house, make sure that you lived in that house for 2 years. Don't sell that house short of a week from making 2 years out of 5 years, where then you don't get to apply your exemption. Okay. That's unless you really have to, because you're forced to for some reason, that's dumb. So it's not like we're saying avoid or ignore the tax code and take it. We're not saying that. We're just simply saying that there are other things to consider in conjunction with that. So turn those stones and make sure you're considering it.
Dan, thank you for closing us out there. We want to thank all of our audience to listen a little bit about tax. As always, we appreciate your viewership and listening. And everyone have a wonderful rest of your day or week. Thank you. Thank you for taking the time to start your journey of thinking differently and listening to LBW talk about stuff they love. Until next time.